Hi guys. I wanted to take a few minutes and walk through the financial modeling assignment number 1 for you in perhaps a slightly different way than Dan did in our class on Monday night. I want to give you a sense of how I think you should approach this and what resources exist to help you do this and what we're expecting to see as you do this. So you can see that I've got my Canvas page for the course opened up to the modules page and for week 3. And you'll notice that in this, that here's the assignment, financial modeling assignment number 1. But I also want you to see that you've got some resources here that may be very helpful in completing this. In this module, you've got the corporate finance quick sheet, you've got the financial statements quick sheet, both of which will help you with some of the metrics and the financial statement structure, etc., that you're going to have to replicate for this financial modeling assignment. But you also have a comparative metrics and ratios quick sheet. We've not shown this to you, and it doesn't follow along exactly along the lines of this assignment, but all of the metrics and the ratios that you're going to want to replicate for this assignment can be found within this quick sheet. It's just that there are many more in this quick sheet than you'll need to use for the assignment. I also have for you a sample spreadsheet that shows you how to structure each of the 3 documents that you're going to need to structure in your fulfillment of the assignment. When I open this up, you're going to find that it doesn't have any formulas in it, doesn't have any equational relationships, it just has values, but at least you'll be able to see how I've put it together. So let me first go ahead and go to the assignment and then we'll walk through it from there. So you should now be able to see the assignment on the screen. And you'll see this comes in 3 parts. The first part asks you to prepare and submit an Excel workbook as a financial model, including a balance sheet, an income statement, and a cash flow statement. The cash flow statement is sometimes referred to as a statement of cash flows, and an income statement is sometimes referred to as a profit and loss. These terms are used kind of interchangeably. So we're expecting that as you fulfill this assignment, given the information provided, you create a balance sheet, an income statement, and a cash flow statement as a set of financial models. And when I show you one of the spreadsheets that we'll look at, you'll have a slightly better idea as to what I mean by that if you don't have that idea already. So the information you're going to use to do this is all found right here. And this will let you not only set it up with the assumptions necessary, but also flesh out any of the fields that are necessary to create each of those 3 documents. The first item I want to show you is to look very briefly at a sample of something that will look like what yours should look like. Now, in this case, it's a different company. It's not using these assumptions, and it has completely different numbers, but it might be helpful to you. So let me try to bring it up for you on this screen. So this is NMM, and this income statement and balance sheet, here's the balance sheet. These were done for December 31st of 2019. So this is the balance sheet, and in this case, it shows you 2 different years of comparison. Now, you're being asked to provide 5 years, but if you can provide 2 years, and if you can set that up, you can provide 5 or 10 or 20. So you're being asked to do 5 years. This is showing you 2. On the income statement, it goes down a little bit further than I have here on the screen. On the income statement, you're seeing just 1 year. But again, you can do comparative years simply by inserting additional columns in here. And some of those columns are going to be fleshed out with some given values, and some of the columns are going to be fleshed out with assumed values. So you'll see better what I mean by that in a few moments when we look at a different sheet, which is my solution to this problem set or this financial model you'll be working on. But notice here that I've got the balance sheet, the income statement, and then I've got the statement of cash flow, or the cash flow statement. And in this cash flow statement, you'll see that I'm simply using values that I've picked up elsewhere. So remember what Dan told you the other night, that when you see templates or when you see statements like this, if it is in regular, just font and not bolded and it's black, it probably is an original entry value. If it is bolded in black, it's probably calculated from those original entry values and might simply be a summation or something like this is. So this value here of total current assets for 2018 is simply the sum of the three current assets, cash, accounts receivable, and inventory that we're showing you for 2018. If it is in blue, like we have over here, it's likely calculated or estimated from either assumptions that we've made or from some of the original entry values. So here we have EBITDA in blue of 1,594,000. Well, you'll remember that EBITDA is EBIT, earnings before interest, tax, depreciation, and insurance. So it's EBIT having added back in depreciation and amortization. Excuse me, I said earnings before interest, tax, depreciation, and insurance. I meant to say earnings before interest, tax, depreciation, and amortization. I apologize. So this value of 1,594,624 is the EBIT for 2019, having added back in amortization and depreciation. So it's using some of the original entry values that you find in these two sheets, balance sheet and income statement. And you'll see that all of these relationships that we note for you here, each one of which can be found in the Corporate Finance Quick Sheet, are using some of the metrics or values from the balance sheet and the income statement. Well, by now you've seen balance sheets and income statements a few times. You've probably even done other assignments with them, whether it's for this class or others. But you're being introduced for the first time to the cash flow statement. And the cash flow statement tends to not be an original entry statement. The cash flow statement, you'll find, has most of its values in blue, which means they're coming from one of the other statements. And in this case, operating income has come from the income statement, operating income. So it's simply a cell reference, not a summation and not an original entry value. Depreciation, likewise, is coming from the income statement. Amortization from the income statement. Here we have changes in accounts payable, changes in wages payable. Those are coming from juxtaposing the 2 years of accounts payable or the 2 years of wages payable to find the change in them. And you'll notice that you're being told in the cash flow statement that subtractions to cash are as negatives, additions to cash are as positives in this first part, and subtractions to cash in the second part are going to be positives, and addition to cash will be negatives. And this is a function of some of what we talked about when we dealt with cash flows in our class on Monday night. If it's bolded here, that simply means it's calculated from within the document itself. If it's blue, it means that it represents some form of what's taking place in the other statement, or we're using some values from the other statement, either referencing or calculating them. But down here, if it's green, it represents an assumption. So you'll see I've made some assumed tax rates. And this would make sense to us, given that this is representing 2018 and 19. We know that the state business tax rate is about 5% flat tax, and the federal tax rate is 21% flat tax. So combined, that's 26% flat tax. And that's going to be relevant for most states and certainly for the federal government. So you have that template that you can work off of, and that's linked for you in Canvas. So if you click on this link, it will give you that template. None of the formulaic relationships are there. None of the calculations are there, because frankly, you need to be able to figure those out yourself. You need to be able to understand how those come together, and you should be able to do that from the discussions we've had in class on Monday nights. Then you'll have a whole series here of different assumptions that you're going to be wanting to use as you put those together. So let me take us to another spreadsheet that is not linked here, but that is my solution to this problem set that you have, or this financial modeling assignment. And so you can see how it came together for me, and this might help you structure this. Let me bring this over from another part of my screen structure here. So here you see, I have the balance sheet. I have the income statement. Excuse me, I have the income statement. And then I have the cash flow statement. And these are structured slightly differently than the one I just showed you, but they have all the same information. And the difference in structures principally is a function of the fact that I have a whole series of assumptions that we're making here. And these assumptions tie directly back to those items in the assignment that you're told to start with this number or assume this number or estimate this kind of a change and such. And I just have it structured a little bit differently in this spreadsheet or on this page, if you will. And I'm not terribly concerned how you structure it on the page. I'm concerned that you structure it on the page. And when I say page, I'm referring to the worksheet that you're working off of. And we're interested to make sure that instead of just hard coding all numbers, you only hard code those numbers you need to. For example, you need to hard code, and by hard code I mean type in the values. You need to hard code the different assumptions, but then you're going to use the different assumptions rather than simply rely on them. For example, here I know that I have been told in the problem that the company starts with a $300,000 cash balance. Well, you'll notice then that that's one of my assumptions right here. Our beginning cash is $300,000. So rather than type $300,000 in again, I simply go ahead and reference the cell in which I originally typed the $300,000, which in this case I believe is cell D49. And then I do a summation showing that this is the current assets because we didn't start with any receivables. We didn't start with any inventory. Similarly, you're going to find that in the problem, you're told that we start with $1,200,000 worth of fixed assets. So I've gone ahead and typed the $1,200,000 into this cell down here, which I believe is cell D40 or D52. And then rather than type it in again up here when I put in the fixed assets, property, plant, and equipment, and that's how it was referenced in the problem, I simply referenced the cell in which I originally input it. And then you'll see in all of these cells, we're talking about changes in some of the different numbers. And so if I go ahead and identify, excuse me, if I go ahead and identify what values I have in the rest of these, I go ahead and reference off of those. Here's an example. You'll note here that we have cost of goods sold of 55%. Well, that's 55% of the total revenue. You're told the total revenue for the first period is going to be $1 million. Cost of goods sold is expected to be 55% of that. So over here in the first year's revenues, I referenced a cell that told me $1 million. Down here in E35. And below it, where I have cost of goods sold, I'm now simply interacting my revenue times the 55%. And again, in the assignment, you're told that cost of goods sold is expected in the first year to be 55% of revenue. You're also told that in the second year, it's 54%, and it keeps going down. So I think going down by 1% a year. So you'll see that in the second year, I go ahead here and I don't type in this 756,000 in cell P6. I simply reference the 54% of the revenue, which in that particular year is shown to be $1,400,000. Well, where did we get the $1,400,000 from? We went ahead and referenced this from taking the Q5, or excuse me, that's O5, and O5 is found right here. Here is O5, I believe. And then in this cell, we've got it equaling O5 times 1 plus F36. Well, what's in cell F36? Well, in cell F36, we see the assumption of our increase in revenues, which is 40%. So if I want to go ahead and do that, then I've taken what was in cell O5, which is my revenue from the prior year, and I'm going to multiply it by 1 plus the percentage increase. I'm not typing any of these numbers in again. I'm typing cell references and I'm typing equations. Sometimes I might even type in functions. And that's what a model is. In a model, none of this should be original input. None of these should be original input. They should all stem from some beginning values that you're given. And we note here a column for start values in each of these statements, and where you'll reference these beginning or start values, and then some relationships that we can drive and some assumptions that we can drive with respect to those. And again, I've got the balance sheet is all set up here for 5 separate years and a start period. The income statement is all set up here for 5 years and a start period. And the cash flow statement is all set up here for 5 years and the start year. So hopefully that gives you a little bit of an idea of how to begin this. You're given a set of assumptions. You're given a model or an example that you can choose to look at here in the MMM financial sheet. You saw Dan walk through some of this in class on Monday night using the same format or nearly the same format that you just saw me use. His looked a little bit different, but it's only a little bit different. And that would help you fulfill the first part of this 3-part assignment, this assignment series. The second part is asking you to do a ratio analysis model based on the information found in the comparative metrics and quick sheet information and the financial ratios PDF. So let me look at each of those for you for just a moment. I'm going to bring in the financial ratios PDF first. Excuse me. So this PDF, exactly as you would expect, is simply a scan out of a textbook, and it starts at page 173, and I think it goes to page 200 and something. And you don't necessarily need to read every word and every paragraph in this, but you'll find that information as to how to construct the various financial ratios that you find within the comparative metrics and ratios quick sheet, you'll find that those are all discussed in here. One of the things you're going to find is on page 196. So I'm just going to scroll down to 196. You're going to find a table. And that table is, excuse me, it must be on 197. I apologize. It's 196, excuse me, 196, right here. You'll see that there's table 5.8. And table 5.8 has a whole series of metrics, some liquidity ratios, some conversion period ratios, some leverage ratios, profitability ratios, and efficiency and return ratios, all of which are discussed in detail with respect to how to calculate them, so the equation, and what they represent within the prior pages of this PDF. So this is a chapter out of a textbook that, and this chapter is evaluating financial performance. And you should review this chapter, and then you're going to use the elements that are there in table 5.8 in fulfillment of the assignment. So you're going to be replicating those. So you're going to want to download that, perhaps print it, certainly save it, and use it for the fulfillment of this assignment. It'd be a good idea to read it. We don't have a textbook for you for this class otherwise, and there's not an awful lot of reading that we're asking. This would be a very good item for you to read. So if you will go ahead and read financial ratios, if you will go ahead and use some of the quick sheet that I gave you on comparative metrics, you'll see all the equational structures. And then you'll use the equational structures and information from these 2 items, and you'll use them to fulfill all of the items in table 5.8 as you then work off of the balance sheet, income statement, and cash flow statement that you create in part 1. I'm going to bring over for just a moment the comparative metrics quick sheet. So I titled this here, Comparative Metrics and Conversion Cycles. I think I have mislabeled it in some of the links that I give you in Canvas. I think I'm calling it Comparative Metrics and Ratios. The title of it's irrelevant to me at the moment. What's in it is important. And many of these, if not most, are also found in the Corporate Finance Quick Sheet. In fact, you'll recognize some of this exact same structure in the Corporate Finance Quick Sheet. So the first thing we're giving you here are some cash burn and liquidity ratios. or cash burn and build, and liquidity ratios. And you'll use a couple of these. You'll use the current ratio and the quick ratio in fulfillment of this assignment. And then you have a whole series of comparative metrics and ratios. And by comparative metrics, what I'm referring to are metrics that we can easily use as we compare either two companies at the same point in time, preferably from the same industry. Otherwise, we're trying to compare apples to oranges. But we can compare two companies at the same point in time, or we can compare our company at multiple points in time against itself. And you'll see things like equity multiplier, the retention ratio, internal growth rate, ROA, ROE, DuPont identity structure of these, and so on. And you see how to calculate them. You've seen Dan or myself put some of this up on the board for you as well. We've talked a little bit of this through, and you'll be using this in a number of different assignments. You'll use several of the elements in this comparative metrics and ratios section of this quick sheet in fulfillment of the assignment, by the way, as you see them represented in that table 5.8 of the financial ratios chapter PDF that we gave you. You'll also see a series of conversion cycles. And conversion cycles are typically cash conversion or equity conversion or sales conversion or inventory conversion, helping us understand some relationship between either cash, sales, operating income and such, and time, or cash, sales, operating income, etc., and other resources that we have at our disposal in the company. These create ratios. And these, again, they're comparative metrics to be sure. And once again, we can either compare them with our companies, so for more than one period of time, or we can use these numbers as comparisons for multiple companies for the same moment in time. We just need to make sure that those multiple companies are apples to apples, so they need to come from the same industry. They don't need to be similar size, however. In fact, that's the beauty of various comparative metrics. They allow us to compare two different companies of completely different size, as long as they're within the same industry. And the reason they need to be in the same industry, excuse me, I said of similar size, I didn't mean to say that. Two companies in the same industry, regardless of size. So we can compare two companies in the same industry, regardless of size. We can do this because it doesn't matter whether you're a $500 billion revenue company or a $500 million revenue company. Return on assets and return on equity give us a sense of how well the managers of the company are using the company's assets or equity to create net income. And so these are ratios that we can compare across that particular part of the board. But you wouldn't expect a software company to have a similar return on equity or a return on assets as you might expect a railroad to have. They're so apples and oranges that you really can't talk about them in a comparison basis. Well, you don't want to talk about two companies of different size in a nominal basis for comparison. You would use a ratio basis for comparison. And so that's what we're giving you here. And all of these metrics can be used in that fashion. So as you fulfill part 2 of this, you'll go ahead and create another worksheet within the spreadsheet that you have given us, the balance sheet, income statement, and cash flow statement. And that separate worksheet will have in it the various financial ratios. Let me go ahead and open up one of my solutions again here and let you see this. So this, once again, is my solution set to what you're working on. And you'll see then that I've gone ahead and listed all of the different ratios that you can find in that table 5.8 of the financial ratio PDF. And then for each of the 5 years, you see that I've calculated all of these values. And you'll find this will be very helpful to you. As we go just a little bit further then, in part 3, you're being asked to analyze the ratios and prepare thoughtful comments on 4 ratio trends of your choice. I don't really care which 4 ratios you use. I care that you've put together an entire table of ratios based upon that which is found in table 5.8 of the Financial Ratios Guide. I care that you've put together an income statement, balance sheet, and cash flow statement as a model. I care that these are linking back and forth together rather than all original entry. And I care that you give me thoughtful commentary on the trends that you see develop over this 5-year span on 4 ratios of your choice. If you've done those things, then submitted the Word document with respect to your commentary and the Excel file with respect to your financial model, submit those in fulfillment of the assignment. You'll have done the assignment well, and you'll learn a great deal in the process. So with that, I'm going to stop sharing the screen. You might have some questions. You certainly will have a venue to ask them, but I'd encourage you to reach out to Dan Cook or myself. Hit us either in email, text, or in WhatsApp to see maybe a little bit more of how we've worked on this. But I think this will give you a good starting point and help you understand some things that might at the moment be a little mysterious to you.